Hey everyone, welcome back to the channel. A while back, I did a video going over how I paid nothing in taxes on my real estate income because of all of the great tax benefits that real estate in the United States offers to real estate investors. And I think the biggest one of those benefits is depreciation. And it can be a little bit complex to understand if you're brand new to real estate investing. Maybe you've heard depreciation thrown around sometime, but you don't really know how the mechanics of it work. Well, I want to use this video as an opportunity to actually go through the step-by-step of what depreciation actually looks like and how you can actually benefit from it on your tax bill. But before we're going any further, I have to emphasize that I am not a tax professional nor a financial advisor. This video is not tax or financial advice, and my only word of advice would be to speak to a licensed professional to take care of your taxes if you're trying to do more complex strategies to make sure you actually do them right, because the tax code is crazy complex and I can only cover so much in a video, and of course it's changing all the time too, so you want to make sure you're getting professional advice to make sure that you're doing things correctly. That's what I did on my taxes. I hired someone to do them for me. I'm just telling you what I've learned through actually investing in real estate and taking advantage of some of these benefits. But depreciation, what does that even mean? That sounds like a bad thing on the surface. To depreciate, you think of maybe driving a car off the lot, it loses a bunch of value right away. Depreciation is not a good thing in that situation because it means that something is losing value. However, depreciation when we're talking about real estate generally refers to your tax bill, in that you're depreciating the value of the property on paper so that you can take that loss, if you want to call it that, it's a paper loss, and then you apply it to your tax bill. And this depreciation loss is looked at as a sort of expense on your tax bill, and in the US, expenses for businesses, including a rental business, are often tax deductible, so depreciation is just one of many different expenses that you can write off of your taxes. It just tends to be a very big expense, especially when you get up to larger sized buildings. But the thing about depreciation in real estate is it doesn't matter if the actual value of the property is going up. It doesn't matter if the property is going down or up in value. You are writing off depreciation on paper because that is what the government allows you to do. It is built into the tax code, and many, if not all, real estate investors take advantage of it. And if they're not taking advantage of it, they probably should, because it's pretty awesome. It would help to actually go through an example to see how depreciation actually works in practice. Now, it depends on the type of the property that you're doing for as to how fast you can depreciate something. With a residential property, you're looking at 27.5 years you can depreciate the value of the property over that time. So divide the property value by 27.5 years. That's basically how much you can write off each year. With commercial properties, not residential, you're going to have 39 years of potential depreciation that you could take advantage of. And the idea there is that a residential property is being used more. You have people living in it, whereas with a commercial property, you're only there during business hours. This is kind of the theoretical, I think, what the tax code is trying to communicate, in that a residential property will depreciate faster if it's not upkept, whereas a commercial property doesn't need as much upkeep since it's not used quite as much as a residential property with people living in it. But that's beside the point. Let's look at some numbers. Let's say you buy a single family home and you buy it as a rental and it's $275,000. So remember, we have 27.5 years that we could depreciate this property. So let's divide the $275,000 by 27.5 and you get $10,000 per year. This means that you have a $10,000 loss that you can apply to your rental income to offset your taxes. The depreciation is an expense on your tax bill, and you get to take advantage of this for 27.5 years on a residential property. So it is a very powerful tax benefit, especially if the actual value of the building is super huge, or if you compare it to your actual rental income, it'll probably encompass quite a bit of it, even if it is a pretty high yielding property. And just to keep these numbers super simple, and we'll say it's a pretty bad deal with very low yield, and you're only making $10,000 per year in rental income, but you don't have any other expenses to worry about. To keep this super simple, that would mean if you had $10,000 in rent, $10,000 of it, because of your depreciation, would be offset by your depreciation write-off. So you would have no taxes to pay in that case. It would be completely covered by depreciation. So you can see how that's a super powerful benefit. And if the value of the property is really great, and if the depreciation is greater than the actual income you're bringing in, all of a sudden you have a net loss on your taxes that you can apply to potentially your personal income, depending on how you structure your real estate business. But you could see that it's very easy to shave down large portions of your taxable income just with this one expense. Before we even talk about mortgage interest write-offs or property management expenses or rehab expenses, not even talking about that. Just with depreciation, in this case, you're getting a $10,000 write-off. That's probably going to encompass quite a bit of your rent, especially after all the other expenses that you would have in a real example. And now at the end of the year, when you actually go to pay taxes, you'll have a much lower bill. You could use those savings to invest in more real estate to get more depreciation, or invest in whatever it is you want. The money from that point on is tax-free. What you do with it from there is totally your choice. You don't have to worry about it because depreciation helped you out. However, there is a catch with depreciation. I'm just focusing on the positive to start. Now we should talk about some of the things to really look out for. One thing I should have mentioned earlier is the fact that land is not depreciable. However, the building on that piece of land is. So when you go to your accountant, the $275,000 that we used in this example, I'm assuming that is the actual building value, not including the land value. An accountant will help you to figure out what the actual building value is. And the idea there is that land doesn't really wear out quickly, certainly not within our lifetimes, unless you really just destroy it. But the tax code doesn't really factor that in. It's looking at the actual building itself, since that's what you're going to have to maintain to actually keep the property operable. It's rare that you're going to have to do much of anything to the land. Of course, there's exceptions, but the tax code doesn't really care about depreciating land. But another thing that you really got to worry about in the long term is if you're holding these properties for many years and you've taken advantage of depreciation for potentially the entire time you've owned the property, you're going to have to pay recapture taxes when you go to sell the property. You can think about it this way. Throughout the entire time you've owned the property and you've been taking depreciation, you've been telling the IRS that the property has been losing value, and you've been putting those losses on your tax bill, and you're benefiting from that, obviously, by not having to pay as much in taxes. But now you're going to sell the property, and if that sale value includes value that you've already depreciated off on paper, the government's going to say, hey, we gave you a benefit earlier, now you got to pay us back something. And that's what recapture taxes are. It is recapturing the value that you already had depreciated in the past. Now, recapture tax rates are subject to change, but even if you have to worry about recapture taxes, it still is probably worth taking depreciation in the here and now. And that's because of the time value of money. Taking tax savings in the here and now so that you can invest the money elsewhere, back into the property and other assets, so that asset value should be growing over time, so that when you actually do pay recapture taxes, you should still be in a much better position than you would have been had you not taken depreciation and didn't have these recapture taxes. The power of compound interest should help you out here, since you're keeping the money now to then invest for however many years, if you even decide to actually sell your properties at the end after taking depreciation. But one thing I will note here is that if you do something like a 1031 exchange, you can actually defer all of those taxes by rolling the money into another property of equal or greater value. There's a lot of rules of 1031 exchanges there. I'm not going to get into them since it can be a little bit tricky to actually make this work. But just know that currently, though the Biden administration is talking about getting rid of the 1031 exchange, it is possible to actually defer those taxes as well and potentially buy a much bigger property completely tax-free there. If you do it right, the 1031 exchange helps you to potentially defer your capital gains taxes and your recapture taxes, again, if you do it right. But that's the basic life of depreciation. You write off the value of the asset, and then when you actually go to sell the asset, if it's more than the value of what you've already depreciated off, then you will have to pay recapture taxes there, unless you do something fancy like a 1031 exchange or some other tax loophole that's built into the system to benefit investors, of which there are many. But now for a bonus chapter, and that is on cost segregation, which is a special type of depreciation that allows you to accelerate a portion of that depreciation. Remember how we're working with this 27.5-year time frame? Well, with a cost segregation, you can actually accelerate a lot of this timeline so that you can take more depreciation up front and have even greater tax savings. Maybe if you just bought a new property and you have all this money that you're trying to put somewhere and shave down your tax bill. A cost segregation analysis can be a little bit complex to do. I've never done one myself, but the general process is that you'll hire someone like an accountant who will then hire maybe engineers or something like that to figure out the value of different types of assets, and will list them all out in a special way for the tax authorities. And then you'll identify what's personal property, what's an actual fixture on the property, and just all the different types of property that you can have in a building. And certain types of property can actually be accelerated in their depreciation schedule. Maybe it's just a couple years, maybe it's 1 year, or maybe it's still maybe 10 or 20 years. But it should be much quicker than the 27.5 years that you would normally normally be working with. This could be especially useful if maybe you run a business and you had a really awesome year income-wise, but you don't have a lot of things to write off on your tax bill. You could quickly put it into a large rental property and maybe be able to write down a large portion of those taxes to avoid having to actually pay the tax bill at the end of the year. It's just one potential way to do it. I'm not saying go do that if that's what happened to you. Everyone's situation is different. But I think it's clear to see how a cost segregation analysis could be potentially very powerful. However, they can be pretty expensive to actually do, and it probably doesn't make sense to do on a tiny property. We're really talking about larger apartment buildings here or large commercial properties where the tax savings would be very much greater than the actual expense of hiring an accountant or whoever's actually running this cost segregation. Because these things are very time intensive, and time is money, especially in the professional services world. I would know, I'm about to become an attorney, and that's kind of our game. We like to bill every hour we can. But that's pretty much it for depreciation. I think it is the single greatest tax benefit of real estate investing. It's one that I've taken advantage of, and it's a large reason why I actually had a net tax loss on my tax bill this year from my rental income when it normally would not have been a loss. And that I was allowed to pull onto my tax bill for my personal taxes because of how I have things set up. So that was a huge benefit for something that really didn't require much extra effort. Had I had that money in a different asset, it's unlikely I would have had as great of tax savings as I did because I own that rental property. But like I said at the beginning, these things are subject to change, and you should talk with a tax professional to make sure you're doing this right, since the tax code is very complex. There's lots of silly rules that you got to follow, but there are lots of great benefits as well. And in the complexity, there are opportunities, but make sure you're actually hiring someone who understands those complexities. This is just an overview of how depreciation works in general and how it could potentially benefit your rental business if you're looking to get into real estate investing, or maybe you're already in the game. But if you like this video, please like it, since that would help the channel out a lot. And if you'd like this sort of content about real estate investing and personal finance, then definitely subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And definitely check out the description below. There's some affiliate links down there, and that would help the channel out too. But until next time, take care.